Welcome to PhillipCapital Weekly Market Watch. I'm Joel Chia, an investment analyst with Phillip Futures, covering currencies and financial futures. As 2010 come to an end, I'd like to share with you some of the global themes that may unfold in the year ahead. Firstly, we continue to see that there will be further upsides to global equities in the first half of 2011. The easy monetary policy embarked by the Fed has created excess liquidity in the markets. In November, the Fed actually announced that it will repurchase $600 billion worth of treasury bills over the next 8 months. This purchase will be financed by printing of money and is a process widely known as quantitative easing. With this extra liquidity, US equity markets will likely be supported until the end of 2011 June. European equities have been depressed by low valuation ever since the region has been plagued by the debt crisis. After the bailout of Greece and Ireland, there has been heightened efforts by the ECB and IMF to contain the contagion effects. We are cautiously optimistic that the combined efforts of the ECB and IMF will produce some results and see some level of success. Hence, we do see some further upsides in European equities. On the other hand, Asian shares will likely to continue to be supported by strong corporate earnings and probably spillover effects by US and European markets. Secondly, we will likely see the devaluation of the US dollar. The quantitative easing measures taken by the Fed will likely weigh on the dollar. While we do not think that the dollar will lose its status overnight, but slowly but surely we do think that the US dollar will diminish in its value. In a recent meeting in November, Chinese Premier Wen Jiabao met Russian counterpart Vladimir Putin to discuss about bilateral trade issues. They mentioned that they will use domestic currencies to settle for their bilateral trade. This seems to be a harbinger of things to come, where you see countries strategizing ways to be detached from the dollar. What can investors do to capitalize on this situation? As commodities are mostly denominated in the dollars, they will likely gain when the US dollar weakens. Some of these commodities include your gold, your silver, your soybean, your corn. On top of that, we do see that commodity-linked currencies like the Aussie and the Canadian loonies gaining in favor of the dollar. In fact, our 2011 target for Aussie USD is at 1.10 and the US Canadian is at 0.9750. Lastly, we do see that the global economic growth in emerging markets like China and India to remain robust in 2011. While developed nations like US and Eurozone are grappling with persistent high unemployment rates and poor GDP growth, we do see that China and India continue to turn in another year of strong GDP growth, estimated at about 8 to 10%. In 2010, we saw China actually raising benchmark rate once and reserve required ratio 5 times. In 2011, we do expect these things to continue, where we see that China may raise benchmark rate and bank reserve required ratios. So what can investors expect? Investors can expect that Chinese equities will likely to be very volatile during each rate hike window and yuan to appreciate against the dollar. As an increase in benchmark rates tend to attract foreign inflows, an increase in demand, an increase in benchmark rate will lead to an increase in demand of the Chinese yuan. Thank you for tuning in. Wishing you a blessed Christmas and a Happy New Year.